YouTube, what's going on? Welcome back to the channel. If you guys have been following me over the last couple of months, we do a Wednesday market live where we're going to go into market data, market trends, so you guys can understand exactly what to expect when potentially thinking about buying or selling here, more specifically in Denver, Colorado. Guys, if you're joining me live, please comment where you are from and any questions you have. And if you guys are catching this after the live, it's okay still. Comment where you're from and comment your questions. And what we're going to do going forward from week to week is I'm going to look back at questions that were asked but not on live, and I will add those into the next live session that we do next Wednesday so that your questions are answered. Ideally, look, I'd like to cater this live market update not only to the general public and go through data and looking at the Denver real estate market as a whole, but ultimately it'd be really, really fun to narrow in on your specific questions and dive a little deeper onto certain market metrics, certain market trends, etc. Now, to set the stage, guys, we're going to do what we always do and start with looking into the Colorado real estate market stats. We're going to look at average price, inventory levels, what's happening in the current market with sold homes under contract showings, ultimately giving you a really good sense and idea of what's actually happening in today's market. We'll follow that up with expectations in the next 3 to 6 months. And then we're going to get into maybe some rate predictions and what the real estate market is going to be like post-election. I think a lot of people have their perception of what's going to happen now that Trump's in office. And I think I have a differing view, which I will get into closer to the end of this video. So be sure to stay tuned. And again, if you're joining, please comment where you're from and what questions you might have. And with that, let's dive in. Good thing for you guys today, I think I finally figured out how to the webcam so that when I'm sharing my screen, we are not losing video. So here we've got stats. We're going to go into pricing first. So if we look at average price per week, I want to specifically hone in on 2024. And so what's cool about the charts that I have access to here is we can look at week to week to week, all the way going back from January 1st. Now, the last week in the market, you can see average price per week has dropped. And that's indicative of the market as a whole. And so when we look at average price, we're looking at the past year was 686. Now, this is for all property types. If we want to just look at single family homes, we can change this right here. And let's look at single family residences. Here in the greater Denver metro area, the major 7 metro counties, we're at 778. And this adjusted. And at first, we were looking at all types of properties, now just single family homes. And as you can see, we've had quite a fall off in price, almost peaking at 820 here in week 42. Rates were really good here. And so I think that's why you're seeing this run up in pricing, that spike right there. And then they dropped when rates went up and seasonally to slow down. So that's where we're at in pricing. And I'm going to go into one other report here so you guys can see. Now, this market, we're looking at Thornton, Colorado. This happens to be in Adams County. It is one of the bigger cities in the greater Denver metro, just north of central Denver. And if we're looking at Thornton, Colorado, we've got all this data here, but where I want to kind of hone in on is medium list price. So if we can look roughly about here, we were in January 2024. As you can see, seasonally, price trend went up. Right in July, it started falling down, and it has kind of been on a downtrend, if you will, since July, beginning of August. And if you look specifically like right here, this was November, the same time in November in 2023 to here, we're up just barely in price. And so, guys, this is a very seasonal market that we are in. I expect it to be this way for many years coming. And what I mean by seasonal is you can see pricing is not really appreciating all that much year over year. you are getting your spikes in pricing, and that's when you're going to want to sell in that spring going into about July when it starts to kind of fall off. You don't want to sell, and then it's going to do the same thing seasonally, generally speaking, every year. So sellers, you definitely want to pick timing so that you can sell for the most amount of money. And buyers, of course, as I've been preaching on the channel, best time to buy, best year. Now, if we're looking at under in solds, the reason we're doing this is it's going to give us a really clear indication of, okay, why is pricing falling and what's actually happening in the market. And as you can see, everything's slowing down. Everything's slowing down. Now, I think part of that is maybe something to do with election and people just hesitant to really make a move prior to the election. And so we might see a little bit of a boost in activity, but my guess would be we're not going to see, if anything, maybe a little increase in activity election. I'll get into more of the reasons why I believe that, but just seasonally, guys, this time every year, the market's going to tend to cool off. If we add in 2023, you could see that same trajectory. If we go 22, same trajectory. 2021, same thing. It's going to fall off. And so, guys, this is just how the market works every year. And we're starting to see that same trend in terms of there's less homes being sold and less homes going under contract. Now, one of the things we want to point our attention to, and guys, I'm going to get into the fun stuff here soon about rate projections, the market after Trump winning election, etc. But a couple more data points that I think are important for you to understand as a buyer, as a seller, are the data points that we're going over. Now, one of the important data points is going to be inventory. Inventory is going to be important is because we really want to understand how many homes are for sale. This is essentially our supply, the amount of homes going under contract and selling. That is our demand. And what is somewhat promising is that we're starting to see inventory decline. It's not a harsh decline, but we kind of peaked out over here in week 38, and we're starting to see more homes go off the market, more expired listings, and less homes coming on the market. And that's par for the course. Gosh, every year since 2020, if you can see here, you see this downtrend line of inventory. But as you can see, 2024 is a drastic difference in the amount of homes for sale relative to the past 5 years. And so that also likely why we are seeing that median price fall and really stay somewhat stable and even when we look at year to date data. It's because there's more supply and less demand because of it. And so, guys, that is our market metrics. There is more that we can get into if you guys want to know more about condos, if you want to know about a specific area. I'm happy to do a deeper dive and analysis for you in regards to those things. But until we get questions, people asking, maybe we'll end up doing a different segment. But really, I just want to encompass the whole greater Denver metro area, which we just did. Now, let's get into rate predictions and the market after Trump. A lot of people that I had talked to that are Republican, are pro-Trump getting into office, they had an assumption that as soon as Trump gets elected, all of a sudden the market is going to do better. It's going to become more affordable for people to buy homes. Rates are going to decrease. And at least right this second, that's just not true. It's just not true. I'm sorry to say, guys. Now, maybe after policies get implemented and Trump's actually in office, maybe 2 to 3 years down the road, that is going to be the case. Maybe as soon as 6 to 12 months. But guys, as of right now, rates have not dropped. In fact, they've went the opposite direction, and the market has seen really no effect based on the election. Now, I actually have a good video detailing the past 10 to 11 elections and what the result of the election had to do with market trends. I would highly encourage going on my channel and watching that video. It is very insightful. But the reality is, after a president gets elected, whether Democrat or Republican, it generally doesn't change the market all that much from where it was already going. If rates were already going in a direction where they were going to change for the better or worse, regardless of who got elected, most times, more times than not, the market still went in the direction that it was already headed. Now, what's interesting here, there may be a slight difference in this election, is that there was some optimism, more specifically in September, that rates were going to improve, and they were going to improve fairly consistently over the course of Q4 of 2024 and going into 2025. The Feds even dropped rates in September. Mortgage rates really dropped about 1% within a 30 to 60 day period, and everything was looking up. And about 2 weeks later, rates went the complete opposite direction, and they continued to do so, unfortunately. And many of the articles I'm reading online are saying rates are going to stay higher for longer, even in the midst of the Federal Reserve dropping rates just recently. And you might be thinking, wait. If the Federal Reserve just dropped rates, then why are we not seeing mortgage rates follow suit? Well, newsflash for you guys: when the Feds drop rates, that does not necessarily mean mortgage rates are going to drop. They're two different things. Now, usually there's correlation, but with the Fed rates dropping when they met in November 6th, November 7th, right after the election, interest rates for 30-year mortgage bonds went the opposite direction. Now, why is that? And what is the difference between the Fed funds rate and mortgage rates? Well, guys, the Fed funds rate is actually the rate, and I'll just show you here. Fed funds rate definition. This is the rate upon which banks lend from each other. The federal funds rate, or Fed rate, is the interest rate that banks charge each other to borrow or lend money overnight. So banks, Chase, Wells Fargo, the major banks, have to balance their books on a 24-hour basis. So overnight, if their balance is not, if their accounts are not balanced, they might lend from Chase to Wells Fargo, or Wells Fargo to Chase, and the interest rate upon which they're lending that money overnight is the Fed funds rate. Now, this is going to more so impact car loans, credit cards, and personal loans through the bank, because the actual bank you're getting that money from, is choosing those rates, where mortgage rates are completely different. They go through Fannie and Freddie and the 30-year mortgage bonds. Now, with all that, what do we predict rates to do? So guys, if you just type in 30-year mortgage rate bonds, 30-year mortgage bonds, do some research. You guys can very quickly understand how this market works. But ultimately, think of this. Trump is in office. Okay, so a lot of people that I've talked to on the pro-Trump side are thinking, oh my gosh, the market's going to get better, rates are going to get better, etc. Well, the opposite is somewhat happening, and I think that's likely to continue over the next 12, maybe even more months. And the reason being for that, now we're going into opinion here. This opinion is backed by, of course, just my analytical mind, doing research, reading articles, and understanding enough of how the market works to be able to speak halfway competent about it. I'm not an economist. I probably don't have much business speaking about this, but here's the thing. First off, in terms of rate projections, I think that with how strong the economy has been showing itself to be through consumer pricing index reports, through jobs reports, etc., many of the economic factors that are a measurement of inflation and how well our economy is doing, rates are potentially going to stay higher for longer. Essentially, for rates to fall, the government, the Federal Reserve, is wanting to see the market slow down and the economy somewhat go in a downturn before they improve the rate. And so, because the economy is quite strong, based on these reports, it's not likely that we're going to see a significant rate improvement anytime soon. Now, on the flip side of that, I don't think rates are necessarily going to get all that much higher, but I think we're probably in for another year of rates being somewhere in the 5 to 7% range. I don't see them going past 7. Don't really see him going past 5. I think we will likely bounce in between about that 5.5 to 6.5 range. Now, let's go into Trump in the election. Well, guys, here's the thing. With Trump getting in office, do you think that the market overall, being that there is a Republican regimen that is going to be taking office, is more bullish or bearish about the markets in general? More bullish, right? And we're seeing that with the price of Bitcoin in the stock market, et cetera. And so when there is investor sentiment that the markets are going to do better, well, then they are likely to move their money into a little bit more risky of investments, because their sentiment is that they're going to do well and there's going to be more gain to be had in crypto, in stocks, and other vehicles for growing wealth. And when that happens, there's less money going into mortgage bonds, which tend to be a safer investment. Now, follow me along here. If you go back to COVID, what was investor sentiment? Oh no, very uncertain. The world's coming to an end. What's happening? They want their money in safe assets, right? And so when money is moving to safe assets, mortgage bonds, there is less need for mortgage bonds to incentivize these investors by giving them a higher rate of return. So therefore, we saw rates in the 2.7 to 3% range, because there was a ton of money being put into mortgage-backed securities. The Federal Reserve, I believe, don't quote me on this, I need to pull up an article and do my research, but I'm almost certain, reading that the Federal Reserve was actually dumping money into these mortgage-backed securities. And so there's a lot of money going to these mortgage-backed securities, the safe money, if you will. And when there's a lot of demand, well, they don't necessarily need to give a high rate on that money, because they don't need to incentivize people to invest there. Well, when we have the Republic regimen coming in and a new administration that in general tends to lead to the masses being more optimistic about stock markets and the business economy, they're investing in other assets, not mortgage-backed securities. Therefore, mortgage-backed securities will likely remain, interest rates on mortgage-backed securities will likely remain higher, because they need to incentivize investors to come in. Therefore, we're not seeing lower rates yet. We'll see in the next year to 4. But right now, that is what we are looking at. Also, if you think about Trump's migration policies and this mass deportation, why am I blanking on the word? Deportation, deporting immigrants. Well, there is some workforce that is being gone. And so there's an argument to be had that cheap labor is going away. Well, if cheap labor is going away and the number of labor pools is being decreased, well, that means that the cost of work, of labor, is likely going to go up. There's going to be more scarcity of it, and therefore the supply, the things that we're going to buy, you can argue that prices are going to go up. And this could be very well of an impact we see on housing, where home prices have to increase to pay for this deficit that they might be experiencing on the labor. Now, guys, for those of you joining just now, remember, this is just opinion. This is just what I'm reading and observing. Whether or not it's true or how it's going to play out, we don't know. I'd love to hear your thoughts in the comments. But if we look at the immigration and the mass deportation, and there being less labor and less cheap labor, well, then prices may end up going up. Not to mention if Trump holds true to a bunch of tariffs overseas, it's going to be more expensive to get goods. And guys, supply and demand ratios might then also be more expensive to get more supplies. So in the short term, I'm not all that bullish on the real estate market changing all that much in favor for buyers nor sellers. To be quite frank, I think we're going to be in a fairly balanced market over the next, I'd say, at least 1 to 2 years, potentially even longer than that, potentially even after Trump's administration. I think we would need to see quite a few things change for the housing market to improve. Now, improve, what does this mean? Well, for sellers, improvement is different than buyers, right? Buyers want more affordable homes. Well, guess what? More affordable homes means one of two things: prices decreasing, which I just gave you a perspective of why that might not happen, or interest rates decreasing. And I just also gave you a fairly detailed example as to why we're not that optimistic of that happening. Well, then buyers like affordability challenges, I don't know that they are going to be fixed anytime soon. Hopefully we can get them fixed. I would hope that we get rates somewhere in the mid 4s to mid 5s. I think that's at a level where homes become a little bit more affordable, but they don't become so affordable on a mortgage standpoint to where prices are going to skyrocket. They will appreciate, but not as much. Sorry, guys. We got my daughter in here and my wife in here. Hi, guys. And so with that, I think there's going to be a fairly balanced market. Sellers, an improvement. Well, for you, an improvement, yes, you could argue would be an improvement for the buyers and homes becoming more affordable because then your home price goes up. But it's kind of counterintuitive for both parties. And so, guys, it's to be determined what's going to happen with the market. But for those of you who are pro-Trump, Republican, they think the market's going to change in their favor and do so in a fairly quick time period. I just don't see that happening. And ultimately, I think what is to come is fairly balanced market. Now, if rates improve, the market will certainly heat up. The market will increase. The home prices will increase. There will be a lot of appreciation to be had. And so the biggest thing you're going to need to look for is interest rates. And if they go down, which is possible, I'm not saying it's not possible. It is possible. In the next 3 to 6 to 12 months, then we could have a fairly robust market. And even with that, I think it'll be a robust market in the favor of everyone. And also be what I said, a balanced market, a robust, balanced market. It's not going to be, in my opinion, all that crazy of a market in terms of home appreciation for sellers. I think there will be some modest appreciation to potentially great appreciation depending on where you live, but there's going to be there's going to be equal benefits for buyers in that rates will somewhat lessen and it will be more affordable to buy homes. So guys, that's it. Thanks for joining my TED Talk. Blake, what's up, brother? Dude, it's so good to see you on my Facebook. You need to get licensed or something. You're still watching real estate content even after you bought a home. Hey man, we got some fun stuff coming to you. I'll take that offline. But thanks for joining, brother. It's so great to have you here. With that, guys, if you have any questions, again, drop them in the comments. We'll get to them next time that we do this Wednesday live next week. And be sure to comment where you're joining from. Cheers.